joining our Upside Avenue educational webinar series. This series is developed with your input, and we surveyed our investors and followers to find out what financial and investment topics everyone is interested in learning about. And then we look for subject matter experts all over the country who can speak on these topics in hopes of providing you with the knowledge and confidence to manage your finances and help you make better informed investment decisions. We want to make sure that you're living your upside. So watch your email for information on our next webinar, and we'll also share that information on Facebook, Twitter, and LinkedIn. So today, we are so grateful to be able to have our guest speaker from Financial Management Network speak to us again, especially on a topic that's on everybody's minds. Jeff has been recognized by American Equity Investment Insurance Company as a top 1.5% advisor. He is also an avid attendee of Ed Slott's individual retirement accounting training seminars and has been featured on the front page of the Daily Press. He continues to give back to schools as an assistant coach at the San Juan Hills School golf team. And we're so grateful to have him again. Before I turn the time over to Jeff, though, I have a bonus guest speaker joining us today, also from Financial Management Network. We have Joe Cavallo with us again. Joe was the first to advance from FMN's rigorous mentoring program and says that there's nothing more rewarding than to see his clients succeed in improving their quality of life and accomplishing their financial goals. When he's not building long-lasting relationships with his clients, he's spending time with his wife, 2 sons, and dog. And with the stay-at-home orders right now, there's a lot of opportunity for that. So please give a warm welcome to our friends from Financial Management Network, Jeff Stanga and Joe Cavallo.
And Jessica, this is Joe. Thank you for the introduction. We now have 2 dogs. My wife thought it would be a great idea to get a puppy within the last 2 weeks. So now we're stuck with a puppy, 2 kids, and another dog in our house.
Love it.
Yeah, for a month and a half straight.
Love it. Well, congratulations on the new addition.
Thank you.
All right, turn the time over to you guys now.
All right, thank you all for joining us. Hey, let's just dive in here. We have a lot to cover today about investing during a pandemic, but what's unique about this pandemic, as we all know, is that, like Jessica said, we are all staying at home. So I think one of the most important things for us to talk about in this before we get started is, how do we work with Upside Avenue? We love coming on, we love speaking with Upside Avenue, and while we're not affiliated at all with Upside Avenue, we do see the benefits in owning real estate, owning multifamily, and both of us as certified financial planners really look to certain areas like that to fill, especially for income needs and appreciation. So thank you very much. Let's look at something here that's really important for the life cycle of COVID-19. I think one of the most important things to do before you even decide to invest during a pandemic or rebalance your portfolio during a pandemic is to, and I say the word attempt very, very loosely because it is very unprecedented what we are through. We don't truly understand the coronavirus or COVID-19, but what we can at least do is look at this assumptive schematic that we have on the screen here that shows all of the different countries and where they're currently at in this pandemic. So uniquely, we see United States here, and we watch the news every day and we get to know what's going on there, but it's always good to see what's going on in the rest of the world. Now, we've probably all heard about Italy and how Italy became the epicenter of the COVID-19 pandemic, especially after China started to tail off. In this chart, we noticed China is now in that recovery phase. So each of these markings you see here, this represents early development, 2 weeks, acceleration, 4 to 6 weeks, late accumulation here, 6 to 12 weeks, and then entering the recovery phase. So China, Korea already entering the recovery phase. I know there's a lot of talk about some type of reoccurrence or reemergence of COVID-19 in the fall. That's something we have yet to really delve into. I'll let Dr. Fauci and his team address that situation. We're certified financial planners. We're certainly not health experts. But with investing, we need to understand a little bit about the infection curve and the stage of development. So we notice that the United States is right in the middle of it. Okay, so we're in that late accumulation phase. You know, we've heard Cuomo come out many times, nearly daily on the news and say, okay, in the last couple of days, we're starting to see less admittances, but yet we are still seeing increased deaths. So what is unique here is that the East Coast has gotten hit, and I think this wave is starting to come to the West Coast. We've heard Governor Newsom in California tell us, hey, we are doing a great job at stay at home, but it's coming, okay? So the West Coast, they're seeing a climax of this COVID-19 pandemic in about 24 to 28 days right now. So West Coast is still staying at home. All the schools have been closed, and we're starting to already hear that schools may not even open in August, maybe even in the September or October timeframe. So that is really the life cycle of COVID-19. And so how does that pertain to investing? Well, my goodness, today was just another huge day for the markets, huge day for government, because the Federal Reserve came out and not only did they 2 weeks ago say, hey, we are going to cut Federal Reserve rates by 1.5%. We're going to purchase securities or do some type of quantitative easing like we did during 2008, right, the Great Recession. And they said, hey, we're going to infuse $2.3 trillion into the government, into the economy, and a little bit into the government via helping more small businesses. One of the big things that's occurring right now is this payment protection program that the government has installed to help small businesses. The Federal Reserve says, hey, we're going to do that as well. And they opened up an emergency line of $600 billion extra dollars. I think that's important for everybody to understand. They opened up another $600 billion to small businesses, to Main Street. And we're talking about companies that have less than $2.5 billion of revenue, less than 10,000 employees. All right. So the Federal Reserve came with another bazooka, if this one wasn't a bazooka in itself, where they said, we're going to backstop money market funds. We're going to backstop investment grade bonds. Now the Fed has come out and said, we are also going to start purchasing high yield or junk bonds, right? You look at companies like Ford, okay? Ford was downgraded to junk just a handful of days ago. So that created a little bit of run on Ford. So you're starting to see this market dislocation that occurred 3 weeks, almost a month ago now, in the credit markets, where people were selling municipal bonds, people were selling investment grade bonds, people were selling high yield bonds just to raise cash because they had no clue when businesses would be able to open, when businesses would be able to start to produce a revenue again. And so the Federal Reserve said, hey, we do not need this type of liquidity issue, okay? It's not like 2008 where banks were failing and making bad loans. In this case, this is the silent killer, right? The coronavirus. This isn't something that was done by private industry, okay? So monetary policy response by the Fed has been absolutely huge, all right? Now, how does this then flow over to the fiscal policy response by the United States government? We're all pretty familiar that the United States government came out with the Coronavirus Rescue Bill, all right, or the CARES Act, right? So loans to large corporations top $500 billion. Here on the screen here, you can see that breakdown. You've got loans to large corporations, between passenger airlines, cargo airlines, all large corporations. I think one of the things that's most important for those that are watching TV and seeing these astronomical unemployment numbers, right? 6.6 million people applied for unemployment last week. against just 2 months ago, that number was about 230,000, to put that into perspective. Okay, so we saw basically a 35x increase in unemployment. So you've expanded the unemployment insurance program by $250 billion. And then a lot of folks have heard about this $1,200 check for everyone. Let me put a little clarity into that $1,200 check for those of you who are thinking, am I gonna get it? Or does everybody get it? Well, no, everybody will not get it. So it's going to be in an income limit, all right? The rebate phases out at $75,000 for singles, and it phases out for people who make above $150,000 and are married or joint taxpayers. And so if you make above that number, 150 or 75 single, you will not be receiving a $1,200 check in the mail. All right. Now, taxpayers with higher incomes in 2020, though, will see any type of overpayment in their taxes rebated or credited on their tax return. So you may not get a check if you're a high income earner, but you may receive a tax credit on your 2020 tax return. Okay, so they're still figuring out how they're going to get all of that money to everyone. I think that's been a very big hang up, not only in the payment protection plan for small businesses who are looking to get 2.5 times their payroll, 2.5 months of their payroll, I should say. So you have now this huge response, both fiscal policy response by the United States government and monetary policy response by the Federal Reserve. Jessica, I think it's quite important for people to understand those things first before we talk about how to invest in a pandemic. So would you like me to open it up for some questions at this point, Jessica, just so in case anybody has any questions about the monetary policy or fiscal policy responses?
Absolutely. If anyone has any questions throughout the presentation, please use the Q&A function, and we'll make sure we address that as we go along, so you can understand the information that Jeff and Joe are sharing with us.
So I don't see anything coming through on the chat just yet, so we will continue on, but if things come due on the chat, I'll pause there and yeah, okay. Okay, so here's a question. I was wondering if their panelists could share their thoughts on REITs and their net asset values being backstopped by the Fed's QE plan. Thanks. Okay, so, REITs come in all different varieties, Aaron. I appreciate that question. And, REITs rallying today, and really the reason you're going to see a lot more REITs that have debt on them rally more so than you're going to see REITs that are more equity-based rallying. The reason you're going to see more REITs that are debt-based is because the Federal Reserve has decided that they're going to step in and buy a lot of those, or backstop a lot of those mortgage-backed securities. So the REITs that have more debt, or CLOs, collateralized loan obligations, CMOs, MBSs, those things are going to probably get back to that NAV a lot quicker than you're going to see these equity REITs. And then when you go into these equity REITs, VNQ is probably the one that most people know. VNQ is the Vanguard REIT. That fund owns about 1,100 different REITs. Okay, so that one's trying to really find pricing right now. I've spoken to some folks that are helping out with that project, but there's still a lot of dislocation in the equity markets because seamlessly it seems like a lot of companies have been able to start working from home. So what's the benefit of having all of this commercial space? So that's the commercial space REIT, Aaron, as it pertains to other types of REITs, mainly residential or multifamily. That's a much longer conversation. Another question we got, do we know by when people would start getting $1,200 checks in the mail for those who qualify? as it would impact rent collections as well from tenants. Okay. No, we do not know when those checks are going to be dispersed, but what they're first trying to do is look at people who have A, filed for unemployment, B, did they receive a tax refund, C, was that tax refund paid to them via electronic transfer or check? Okay, so Ritesh, I hope I pronounced that right. What they're saying there is, look, you received an $1,800 tax refund last year. We sent it to Bank of America. Perfect. We already are going to send you $1,200. When is that going to occur? We don't exactly know yet. They're trying to get this thing done, honestly, in the next couple weeks, but we don't know. The biggest problem with that is a lot of the folks who are going to be receiving that refund don't have the best banking relationships. You know, people who make less than that $75,000 while still a good wage, they don't have the banking relationship that somebody who makes $300,000 a year or more has. So they're really trying to figure out how they're going to get the money into the hands, especially of these millennials who don't like big banks, right? They'd rather bank with Square or Acorns or something like that. Okay, so we'll pause for questions right there. Mark Ferguson, you have a great question here. We'll answer that. Still puzzled why bonds and stocks were moving down in tandem. Actually, Mark, I will take that very quickly. They moved down in tandem because of liquidity. Okay, the reason bonds came down is bonds have a rating to them. If you have a bond that is, say, AA rated, and you realize now that that company is going to be closed for the next 3, 4, 6 months, that bond now is probably going to get downgraded. Let's take Ford Motor Credits, right? Ford, good, large company, they say we're closing all of our plants. What happens? Their bonds get downgraded. When a bond gets downgraded, people are not willing to pay the par value. They're not willing to pay $100 for a $100 bond at 4% interest rate when something just gets downgraded. If it gets downgraded, you now have to sell that bond for less, Mark, in order to get your money back. Okay, so bonds and stocks move in tandem when you have huge market unknowns. Now, the bond market has rallied back, and that's why you see and that's only because of that quantitative easing by the Fed. If the Fed did not step in there, the bond market would be in so much turmoil, more so than the equity markets, okay? Because now you're going to have defaults, bankruptcies, credit downgrades. It would be an absolute mess. It would make 2008 look good. Okay, so hope I took care of that one. And yes, bonds are recovering. So I think it's important for people to keep things in perspective. I think a lot of the times what we're noticing is that we see a downgrade in credit, or we see a huge sell-off in the equity markets, and people are sitting here saying, should I sell? Should I get out? And panic and emotion overcome them. And our job, Joe's job specifically as a wonderful certified financial planner, is to help keep things in perspective. On the screen, you see all of these different issues: Black Monday, tech bubble, financial crisis, US credit downgrade, and stocks got hammered. Yet within the next 12 months, look at that rate of return: 20, 30, 60% rate of return just in 12 months, okay, for some of these things. Now, I understand that this pandemic is different than a lot of the things that you see on the screen here, but every market sell-off has its own issues. Yet at the same time, markets are resilient, okay? Markets reward discipline. When you are a disciplined investor, you have the ability to take advantage of certain lows, both in credit markets and in equity markets. And so on the screen, we have this beautiful chart that shows you all of the issues that have occurred just in the past 10 years. You know, if I put something up that includes the last 50 years, we wouldn't even be able to read it. There's so many issues. But you see here, you've got the BP oil spill that we all know about. We have the Ebola virus, US government shutting down. And what this tells you is that most of the time you'll have these dramatic sell-offs like we did in 2018, like we did in 2015, and yet markets over time are resilient. So for those of you who are out there asking, well, should I sell, or should I get out? What should I do? Here is our piece of advice. All right, know what you own. Okay, so if you're going to take anything away from today's conversation, please take this away. Know what you own. And what does that mean? If you own a mutual fund, okay, go and Google it. And I'm going to put this on the screen now. I Googled SPY, the S&P 500. When you go and Google the S&P 500, please go to use Yahoo Finance or use Morningstar. Click on their holdings. And then before you decide to sell, look at it. Ask yourself, do you want to own these companies? Do you want to own Microsoft, Apple, Amazon, Facebook, Berkshire Hathaway? I'm not going to answer that question for you. That's something that you and your advisor need to answer. If you want a conversation with us offline, we certainly can do that. But I know this, when I look at names like this, I'm not exactly inclined to hit the panic button, okay? So you have to know what you own. So for those of you on this call, please go Google, use Yahoo Finance, look at the funds that you own. Yeah, if you own a bunch of, casino stocks and cruise lines, again, I'm going to make a recommendation for you because I don't know your specific situation, but you may want to shy away from certain things that have such volatility like that, unless of course you're a day trader. But for those of you who are looking for a long-term consistent growth, consistent income, consistent portfolio, whether it's a mix of real estate, stocks, bonds, commodities, you want to know exactly what you own. So Joe, I'd like to get you in here. Joe, tell us, rebalancing. I know rebalancing is something that you've done a lot of, and it's a response to market volatility. So Joe, if you wouldn't mind popping in here, tell us how rebalancing works. All right, Joe, I believe you're still
on mute. Hold on.
Yeah, Joe's still on mute there.
There we go. Is that working?
Yep, we can hear you, Joe.
Sorry about that. I technical difficulties, I guess. Yeah, no, rebalancing is absolutely something that is a proven method that if you can stay consistent, stay disciplined, then over time you will succeed more so than those who are what Jeff was referring to earlier, emotional, panicking, and ultimately selling in these really, really high quality companies. So some of the things that we think about during this time period, as hard as it might be, is again, sitting with our clients, communicating what is the plan? What's the plan for the money? What's your long-term plan? And making sure that we're factoring that into the discussion. And that allows us to take emotion out of investing. Emotional investors are the ones who get beat up the worst. People who stay disciplined and stick to the strategy and believe in the long-term approach will prosper. That part of that approach, a big part of that approach is rebalancing. So some of the things we've been doing over the last couple of weeks is really taking money from areas that have really held up well, relatively well, I should say. Jeff mentioned bonds earlier, fixed income, how it did go down. I think, Ritesh had the question of why the bonds went down with stocks because of the panic sell. Well, they have come back, and many of our bond positions are actually flat or up for the time period. So we're looking at it as an opportunity to liquidate some of that and buy into some of these really, really good companies that we think are going to come out of this and continue to be successful. Companies like the Microsofts, companies like Apple, companies like Amazon, Home Depot, Target, these really just well-established, weathered companies that have been through some tough times.
Hey, Joe, I appreciate that. That's great on the rebalancing, and it's nice to see that you're doing that with a lot of our clients. I know that you've been heading that up for us where you're saying, let's look at your situation. Now, Joe, when you look at someone's situation as a certified financial planner, how are you differing between somebody who's like yourself, a CFP, versus somebody who is sitting here using a, Wirehouse or a Charles Schwab, Merrill Lynch type of an individual?
Yeah, I think it really comes down to knowing who we're working with and the relationship. And it's, we have a very in-depth knowledge of our client's situation as it pertains to not only their investments, but everything about them, their taxes, their cash flow, their estate plan. All these different things have, did I lose you there, Jeff?
Nope, I'm still here.
Oh, I lost the panel there. Sorry about that, guys. So it's really about knowing the situation and being able to apply certain planning tactics, especially in times like this where we see opportunities, not only on the investment side, but on many other areas of their finances. We can take advantage of opportunities because we know our client situation. Some examples, Jeff, if you want me to get into examples right now, I'm happy to do that.
Yeah, Joe, I think that'd be great, and then for those of you who have some more specific questions, please type those now. We'll be taking questions in a little bit. I think one thing that we want to focus on here is, again, before we get into a couple examples is, again, for those of you who didn't catch it, you want to have that diversified portfolio evaluated and knowing what you own. Mark brought a great question about, puzzled about the bond stocks. Bonds come in so many different varieties. Bonds are much more confusing than stocks. So for those of you who are out there saying, do I sell, do I get into cash, or do I invest more? How do I do this? Please go and check out what you own. To give you a very specific situation, junk bonds, JNK, that's the ETF, largest ETF out there. That is a lot different than AGG, the aggregate bond market. The aggregate bond market holds 57% of money roughly in Treasury, United States Treasury bonds. JNK, junk bonds, have a higher yield because they're investing in junky companies. So again, when you see your statement and it says bonds, there's a huge difference between GG, ag, and JNK, junk. So please go, figure out what you own. Yeah, Joe. So what are some of the conversations that you guys are having right now with your clients?
Well, as it pertains there, I imagine many of the participants on this webinar are real estate owners or interested in owning real estate or have owned real estate in the past. So I had a conversation with a client about a week and a half ago whose primary source of their income is actually multi-tenant properties. And her concern was, tenants not paying rent and her income going down pretty substantially in anticipation of them not paying the rent. So the comforting thing that we had is again, going back to knowing her situation, knowing what she has, and looking at the whole comprehensive picture of her entire situation. And I was able to communicate to her, well, because of the planning that you've done, you're set up in a way where you can weather this storm for a number of months, not just the next month, but the next 3 to 6 months, where we have your investments, your portfolio set up in a way where we have assets that are what we consider immediate term need money or emergency money. You guys might have heard that term, emergency fund, to be able to weather this storm. And it brought great comfort to her knowing that. And because of that, she was able to really now plan out, focus in on, okay, now how do I focus on my real estate business to get it back up and running? How do I work with my tenants in the short term, debacle that we're in right now? Other cash flow items that we're talking about with clients, many of our clients are on a fixed income where we're sending them income from their portfolios. Well, I'm talking to them and saying, guys, you're stuck at your house. Your expenses have probably gone down 20, 25, 30, sometimes even 40%. Let's factor that into the mix here. Should we be sending you less money from your portfolio and preserving the money in the portfolio, reinvesting that possibly to get some of these good companies at a discount, and continue to send you less money, at least over the next couple months? So some of the things we've been thinking about with our clients, if they have a reduction in their salary, goes back to, there's concern there. There's definitely concern, but we look at the plan, we look at your cash flow and we say, well, yeah, your salary went down, but again, your expenses have gone down too. So it's really kind of a wash in a way. And that just provides that ease, that sense of calm for our clients in those conversations.
you guys are really dialing in that cash flow now, especially when, even though you've already dialed those cash flows in and created this bucket strategy approach. And I want you to get to that bucket strategy approach that you've been working on. One thing to mention, because Joe talked about landlords, there's about 8 million individual landlords in the US that own between 1 and 10 properties. And, they own and manage half these rental properties in the nation for about 48 million renters. And a lot of people who aren't paying rent right now, there are forbearance programs out there by your bank. So if you are a landlord, if you own pieces of real estate and your tenant is not paying, then you can call your bank and have some type of forbearance. Forbearance is basically taking 3 months and they're going to add it to the end of your loan. I know this doesn't handle all of your costs, right? When it comes to the electricity and trash and all the other utilities on there. But I think for those of you who are individual owners, looking at that. Now I'm going to say this: if your tenant's paying you, I hope you're still going to be paying that mortgage, right? Because you're going to need to show that you're actually being affected by this coronavirus crisis, and then you're not just collecting rents and not paying that mortgage, right? So, Joe, you shared with me how you created that bucket strategy for your retirees. Do you want to touch on that?
Sure. Yeah. The bucket approach. It's a simple way of delivering the diversified method and how effective it can be. And how I deliver that message to clients is understanding and compartmentalizing your investments in the form of buckets. And you look at bucket number one, that's going to be my immediate term money that I know I'm going to need for the next period of time. And it ranges from different clients. The average is usually between 2 to 3 years. I need to know that money is going to be secure and be able to provide the income that I need for the next 2 to 3 years. That's my bucket number one. Bucket number two, and I should build on what's owned in that type of bucket. So we're owning things like it's going to be cash. It's going to be high quality fixed income investments, short-term municipal bonds, bond type of strategies where we know that there's Jeff talked about crediting for bonds. We want grade A bonds, structures that we know are going to be just fine coming out of these crises. Bucket two is going to be a little bit up on the scale of risk, where that might be maybe real estate that you own that has some type of appreciation component to it, but it's also maybe providing some type of income that's feeding in to that first bucket there. And it's going to be a little bit more secure than the third bucket, which I'll get into. But that middle bucket is really designed for 4 to 6 years, 4 to 10 years out, where we can take a little bit more risk with it, knowing that we've got some time to let it recover. But we also want to make sure that it's not the type of risk like the stock market, which leads into bucket number three. Bucket number three is going to be equities, those great companies that Jeff pointed out several minutes ago that we know are volatile. But when you look at a long-term period of time, 10 years plus, that's going to be the place where you make the most money inside your portfolio. We know that, especially like times right now, it's not the time to sell right now. We definitely don't want to be sellers of equities right now. We want to be buyers. If you're in a position where all of your money is in bucket number three and you need an income from your portfolio, well, what do we need to do? We got to sell equities. We got to sell those stocks at a discount. It's almost a fire sale. And that can be detrimental to a long-term plan, which is why, again, we have that bucket number one for the security and for the diversification.
Great. Joe, I want to have you touch on one more thing for a couple minutes here, because I saw you do a really cool tax strategy the other day with one of our clients. So folks, listen up here. Here's a cool tax strategy if you own equities outside of a retirement account. Joe, do you want to touch on a cool tax strategy that people can take advantage of possibly?
Yeah, there's a few things we've been thinking about over this last month that's presented opportunities. And I have to remind you guys, it goes back to knowing your situation, knowing the clientele that you're working with, and making sure that your advisor knows everything about your situation to be able to provide this kind of advice. Because while this doesn't have a direct impact on investments, the saving you taxes, whether it's now or in the future, has an impact on your wealth, and it grows your wealth. So a couple things, just on the small things that we usually do towards the end of the year is tax loss harvesting. That's the idea where we actually maybe sell a stock at a loss and recognize the tax loss there. That gives our clients the ability to deduct that on their tax return and ultimately save them taxes. Well, what we do in turn is we're selling maybe a loser, and we're taking those proceeds and buying a possible winner and what we feel is going to do well, maybe semiconductors or some type of tech type of play, and a company that we feel is going to be just fine coming out of this, and that's actually going to do better than the investment that we sold. So tax loss harvesting has been a huge part of our practice over the last couple of weeks. We've been doing a lot of that for our clients very proactively. The other one is a little more. Yeah, sorry, Jeff, go ahead.
No, that's great. So tax loss harvesting. So basically you're saying, okay, if I sell something, I can take a deduction on that up to $3,000 against any other capital gain I've had. That's great. That's really good. And then if you buy back in, if you buy something else, maybe a different ETF or a different mutual fund that is in the same sector or same space, you're saying not only do I get the tax deduction or the tax credit that sits there, as the market rolls back up, I'm not going to have to recognize those gains only above what loss I took, right? So that's good.
Yeah,
so
I mean, it's more importantly, you're still participating in the recovery. That's what you do.
Okay, awesome. Yeah. So
the other tax, and extremely important. I would encourage you all, if you do have retirement plans, to be thinking about this or talking to your advisor. And again, if you want to chat with Jeff or I after this, we'd be happy to talk to you about the strategy. And it's really a process of taking money out of a pre-tax retirement account. So that could be a 401k plan or an individual retirement account or an IRA, as it's called. And we actually are taking money out of those accounts and transferring them to what's called a Roth IRA. What's the difference? The money that you put into that 401k and that IRA, you have not paid taxes on that yet. You haven't paid tax on that. You got a tax deduction for it, which has been a good thing. Well, now what we're doing is we're saying, well, I'm going to take that money out, or a portion of it out. I'm going to transfer it to this Roth IRA, and I'm going to pay taxes on it right now. But once that money goes into that Roth IRA, I can reinvest the money, and it grows tax-free. Absolutely huge. So if you're in a lower tax environment, this is a period of time, a great opportunity to be able to convert money from your regular retirement plans to your Roth IRAs. Huge strategy, guys. I highly recommend asking your advisors about that.
I like that, Joe. I like that Roth conversion a lot. Hey, we got a couple questions here, Joe and Jessica. So let me just fire them off here.
Sure.
One, what is the best way to think about amount of funds in bucket number one? Let's go back up there. Bucket number one. How many years should that cover? You know, what we look at there for the person who asked that question, we look to cover 1 to 3 years worth of the gap between your income and your spending. Okay, so if you have Social Security or a pension, or you have incomes of say $3,000 a month, you're spending $5,000 a month, you want to keep $2,000 per month, right? Times 12 or 36, and that is your bucket number one. So again, you want to cover that gap between your income and your spending needs for bucket number one. Second question that came in, do you think the current circumstances are good to buy or sell a house? My thought is that real estate is going down. It could be worse than 2008. How do you think and advise? And this is someone who's asking about rental property. So, Joe, would you like to tackle that one, or shall I?
Yeah, I mean, it's going to depend on really what your long-term plan is for that property. If you're thinking of this as something that I want to provide an income for me 20, 25 years down the road, I don't think it's a bad time to buy property at all. You look at the rate situation with rates. Rates are very low. It's inexpensive to borrow money to buy real estate, which is a good leverage tool. And I think that's going to continue. We also look at the majority of the population right now, and this is just something that Jeff and I have been thinking over for over the next 10 years. Who's going to buy property? Who's going to be buying property? If you look at the largest population right now, it's millennials. And millennials are all in the age 10 years from now, they're going to be mid 40s to all the way down to their mid 30s, maybe early 30s. And that's prime time real estate buying. They start their families. They're going to want to own real estate. We think that that's going to provide a nice wave of buying power in the real estate market that could actually propel this moving forward. If you're looking at it on a more short-sighted, 1 to 3, 2 to 5 years, yeah, it might be a little more risky. There definitely could be some falling out with what's happened here with 29% of the U.S. economy literally being closed for the last month. That's going to have some ripple effects on spending, on corporations and how they're spending money and how they employ people. So I would ask the question, what's my long-term goal with this? And I think there's going to be some nice opportunities that come out of this on the real estate front, no doubt.
Great. So it sounds like there are 3 questions I know that you and I are really asking all of our clients right now. Has this most recent pandemic changed your time horizon? Were you a long-term investor and now you are a short-term investor for some specific reason? Has your investment time horizon changed? That's the first question you want to ask. Second question you want to ask, what are your income needs now with this coronavirus? Did you have a decline in income? Did you have a loss of a job? What is your income, or what are your income needs? Okay, those 2 questions. And then what is your long-term outlook? So those are 3 questions. Those are 3 questions that if you guys and gals out there have questions on or can't answer, or you're not being answered by your current advisor, feel free to contact Joe or myself. We can sit there and help you decide what those answers are, and then at that point, you can sit there and go through tax planning, go through the investment planning, go through the risk management. And once you've done that, you can not only not panic as much in a certain situation like this, but you can take advantage of it. Consider you were able to get in when the market was at S&P 2200, and today the market's at S&P 2800. That'd been a 25-30% rally on that purchase. So Jessica, let's open it up for some questions now, unless Joe, you have anything else to share with people.
No, thanks, Jeff. No, I think I'd be happy to listen to some questions and hopefully help answer those.
Yeah, so one question we have here, it seems the market has recovered a little bit, but now, it seems that the market has recovered a little bit, but it could stretch more. Already have 12 months of cash. Will you buy or sell stocks now during this volatility, or hunker down on your current exposure? If you have 12 months of cash set aside and you have the ability to rebalance your portfolio, meaning you had some bonds that held up and you had stocks have seen a nice rally off of the low. Keep in mind the high for the S&P 500 is in that 3,300 range. So we're still 500 points away from that high. I'm not saying that we'll get back up to that high anytime soon, but what I'm saying is there are still good companies and good things that you can be buying out there. So if for our clients who already have that 12 months of cash sitting aside, we're looking at buying, and we're not looking at buying necessarily. We're looking at buying domestically and internationally. We're looking really across the globe. When you have companies like that are large companies that are in the healthcare sector or that are trying to provide things for the coronavirus, those are companies that are probably going to be poised to be really good, coming out of the coronavirus.
I'll just add to that too, Jeff. it's really about what you own too. And it's, you mentioned it's, rebalancing, buying, and then also having liquidity, but you also want to think of industries too, and what industries are going to be just fine coming out of this. Certainly hospitality, retail, um, those types of service industries are going to be slower to recover. You look at
Yeah.
a company, like Disneyland. Disney is incredible. It's an incredible company. Long term, it's going to be just fine, but it's going to be slower to recover. I mean, I can't imagine them opening up the parks to everybody over the next 3 months to 6 months. It's definitely going to be a slower process for them, and that's a huge revenue source for them. But you look at a company like Nvidia, or you look at a company like Amazon. Those types of companies that are people need. It's more of an essential. It's going to be revolutionary as far as this tech revolution. And you want to be thinking industries, which in some, I will say it's important as an investor to be thinking about the specific companies and industries that you're investing in rather than just an index. The index, I think, is going to be a tough place to be because it has exposure to everything, whereas you want to be more focused in and really know, again, what Jeff said earlier, know what you own. Look up what you own and make sure when you're looking at those companies that they are ones that are going to continue to flourish.
Hey, so Joe, if somebody's got some extra cash on hand, here's a question. What's the best way to treat that cash, or do you just kind of hold on to that cash? It sounds like what you're saying is if you've got extra cash on hand, right, look to be opportunistic. And one way, and I'll answer this a little for us here, one way to be opportunistic and still mitigate risk for everyone out there is through dollar cost averaging. Dollar cost averaging is a strategy where if you have $10,000 that you want to put into the market, instead of putting all 10,000 in at one time on one day, you say, okay, I'm going to do $1,000 per month over the next 10 months, or I'm going to do $2,000 per month over the next 5 months, right? So you say, I'm going to first pick my positions. I'm going to pick a couple stocks, or I'm going to pick a mutual fund that isn't the index. And what Joe means by the index is just the S&P 500. He's saying be a little bit more active with your investment, and then dollar cost average in. Hey, every 30 days you're going to buy some of it, because if you do that, you then have the ability to buy on the way down more shares, and as it goes back up, you're buying less shares, but you're still participating in that rally. Can the moderators share their thoughts on which industries they believe will outperform the market over the next 6 to 12 months, i.e. semiconductors, ? Thanks. Joe, do you want to jump in on that one?
Sure. I love semiconductors. I think that's a great call. And you go back to companies like Nvidia that secretly they're kind of making a presence here. And if you look at what's these online communications and how companies are going to go about doing their business later on, like what Jeff said, with people working from home now, companies like Nvidia are going to be leading and pioneering the behind the scenes tech on that. So I love that idea. Tech in general, we love the idea of investing in the millennials. You think of things like Home Depot, you think of things like Target, those types of companies that are going to be just fine. People and millennials are going to be, we believe, buying homes, starting families, investing money into those types of industries that are essentials to grow their families. So that's the kind of things that we're thinking about. But it goes back to you say 6 to 12 months here. It's tough to say 6 to 12 months. It's tough to say how much of a ripple effect this shutdown is going to have. So I would really, again, preach that keeping a long-term perspective on your equity exposures is extremely important. I would look more 3 to 5 years down the road rather than 6 to 12.
Yeah, and if you use that 3 to 5 year clip too, Joe, what that combats? It combats getting out early. If you're a 6 to 12 month investor and you go and you were a purchaser of Amazon, or you were a purchaser of Apple, or heck, almost any stock, in 2010 through 2012, if you didn't let that thing ride, you lost out on a lot of gains there. So having that long-term perspective, I'm going to go on there on that as well, Joe. So you like the semiconductors and tech, yeah, I'm a big fan of the home build. I can't tell you how many people I've talked to in San Francisco and New York City and Los Angeles and over the past couple of weeks who are really questioning paying the exorbitant amount of rents that they pay for a 1,200 square foot apartment. So you're gonna start seeing these millennials say, maybe I don't need a tiny home. Millennials have loved tiny houses, iPhones, and craft beers, right, for the last decade. Well, I think that's about to change here. So again, I like your call there, Joe. Long-term investing, home builders, tech, consumer staples, things, healthcare, things that I personally like to shy away from right now, travel and leisure. I just don't know how this economy is going to pan out. I'd rather get some more data first. Yeah. Any other questions out there? Jessica, any questions for us that you've seen come through?
Let's see. I did see one more. I think it was more of a comment, though. It says, felt the index is still high. 2008 index was lower, at 7,000 to 9,000 before the COVID-19 IT was up 28,000 up. Now it was still around 23,000. That's something you guys?
Yeah, that's right. That's more of a comment there, right. 2008. Yeah, we had a big sell-off, and we've already seen a big sell-off. Big difference here between 2008 is that Federal Reserve and the government were reluctant to give a bailout. They were reluctant, and they were slow to infuse cash into the system. That is not the case here. I am not going to tell you that the market's not going to go down or that it is going to go up, but I can tell you this: you have never, ever in the history of this country, in the history of this world, seen such a concerto of efforts by the federal government and the Federal Reserve. And so, when you have all of this support, and globally you're starting to see, the European Union trying to figure out a bailout package, when you're seeing trillions of dollars being printed to be put in the hands of small businesses to keep their businesses afloat, and the Federal Reserve telling you, we are going to, quote, vigorously recover. Okay, that is from Jerome Powell. That's what he said this morning. Vigorously recover. Gosh, it's got to give you a little bit of goosebumps here versus 2008, when the banks were just making loans to everybody and trying to make a bunch of money.
And I'd also, again, go back to tech real quick. I mean, we're in if you look back 3 years ago, we wouldn't be having this this presentation, Jeff. I mean, it just wasn't possible. But the tech revolution here is really allowing us to be able to do these things, allowing people to work from home, allowing companies to be more efficient. It's not just it's not just with one or two companies these days. With every company, it's really a revolution here, and I believe that that's going to continue to drive this economy moving forward, really over the foreseeable future. Some things to be excited about.
Mm-hmm.
That's great. Well, I don't see any other questions coming through, and I know we've taken a lot of everyone's time. Thank you again, Jeff and Joe, for joining us and for sharing your knowledge and giving us some insight into what we can do with our investments during this unique time in our lives. I don't think anybody would have thought we would have lived through a pandemic during our lifetime. And I want to thank our listeners for joining us. If you'd like to connect with Jeff and Joe, let's see, Jeff can share the contact information right there. If you like the content we've been sharing with you or have any suggestions on other financial investment topics you'd like us to cover, please let us know. There'll be a survey available for you to take at the end of this webinar. So let us know what you thought of this webinar, as well as what other topics you'd like us to cover in the future. And we'll find subject matter experts like Jeff and Joe who can speak on these topics. So watch your email for our next webinar. And we want you all to stay safe and stay healthy. Thank you again for joining us, and start living your upside with Upside Avenue. We provide access to professionally managed, diversified portfolio of income-producing multifamily real estate for as little as $2,000. And you can visit our website at upsideavenue.com for more information or call us with any questions. Thank you again, Jeff, Joe. Thank you again for your time. We always love having you guys with us. Please stay safe, stay healthy, and have a wonderful day.
All right.
Thank you. Thank you, Jessica. Thanks, everyone.
Thanks. We'll see you again soon. Bye now.